The current live trading price for Burlington Stores Inc., ticker symbol BURL, sits at precisely $296.51 USD, marking a significant intraday surge of 14.14 points or 5.01% in positive territory. This 5% jump in a single session is not just a standard deviation, it is a violent repricing of value that demands your immediate attention. When you look at a move of this magnitude in the typically sedate sector of off-price retail, you might assume it is merely a sympathy play or a reaction to a singular headline. But that assessment would be superficial. The reality is far more compelling and speaks to a structural rotation occurring in the broader market right now. Most investors, perhaps even you, have spent the last 18 months fixated on the semiconductor cycle or the AI boom, watching NVIDIA stock or Tesla stock for cues on where to deploy capital. The general expectation, the prevailing narrative, is that growth only exists in silicon and software, and that brick-and-mortar retail is a slow-motion car crash yielding to e-commerce dominance. You might scroll through your Robinhood app or check your SoFi investing dashboard and see red across consumer discretionary names, reinforcing the belief that the American consumer is tapped out. However, the reality we are witnessing with Burlington today is a direct contradiction of that bearish thesis. This surge to $296.51 USD isn't about a strong economy. It is about a bifurcated one where the trade-down effect is becoming the single most powerful driver of corporate earnings. Burlington is not winning because everyone is rich. They are winning because the middle class is feeling the pressure and migrating en masse to value. This is not just a stock moving up, it is a signal that the smart money is betting on a prolonged period of consumer austerity where price point wins over brand loyalty. Let's examine the mechanics of this move specifically. A 5% gap up on a Monday implies institutional accumulation, not just retail speculation. If you were monitoring the order flow on an Interactive Brokers trading terminal, you would likely see large block orders hitting the ask, clearing out supply, and forcing market makers to adjust their books higher. This kind of price action often precedes a major earnings event or a significant analyst upgrade that fundamentally alters the valuation model. In Burlington's case, we are seeing the market begin to price in the success of the Burlington 2.0 strategy, which we will discuss shortly. Unlike the erratic swings you might endure with Robinhood crypto holdings or high-beta tech plays, this move in BURL is backed by tangible improvements in inventory turnover and margin expansion. The volume accompanying this rise suggests that fund managers, perhaps those running Fidelity mutual funds or Fidelity ETFs, are aggressively rebalancing their portfolios to capture this defensive growth. They are rotating out of high-multiple risk assets and parking capital in companies that thrive when inflation remains sticky. It is crucial to understand why this specific price point of $296 is technically significant. For months, the stock has battled resistance in the 280s, a level where sellers previously stepped in to take profits. Breaking through this ceiling with such conviction indicates a change of character in the chart. If you are engaging in self-investing or managing your own assets through Schwab Intelligent Portfolios, you know that a breakout on high volume is often the safest entry signal in technical analysis. It suggests that the overhead supply, the investors waiting to sell at break-even, has been absorbed, and the path of least resistance is now higher. This is the moment where the fear of missing out transitions from the retail crowd to the institutional crowd. The hedge funds that were shorting BURL as a hedge against a recession are now being forced to cover those positions, adding fuel to the fire. This short-squeeze dynamic, combined with genuine long buying, is what creates the potent 5% candle we are seeing today. Now, let's look at the fundamental engine driving this. Burlington Stores operates in the off-price segment, a notoriously difficult business model to get right. The expectation is that they just sell cheap clothes. The reality is that they are a logistics and data company that happens to sell apparel. Under the leadership of Michael O'Sullivan, who came over from rival Ross Stores, Burlington has been undergoing a massive operational overhaul. This isn't just about opening new stores, it is about changing how they buy and move goods. They are shifting towards a more agile buying model, holding back a significant portion of their open-to-buy liquidity to pounce on market dislocations. When a full-price retailer cancels an order because of a cool spring or a supply chain snag, Burlington swoops in, buys that inventory for pennies on the dollar, and has it on their racks within weeks. This agility allows them to offer branded goods at 60% off while still maintaining healthy margins. If you are using Fidelity Wealth Management Services or getting investment help from a professional, they might tell you that retail is cyclical. But Burlington is proving to be counter-cyclical. When the economy sours, their traffic increases. We are currently seeing a phenomenon where households earning over $100,000 a year are starting to shop at off-price retailers. This demographic shift is explosive for a stock like BURL because these customers have larger basket sizes. They come in for a deal on a coat but leave with home decor, beauty products, and accessories. The market is realizing that Burlington has a long runway of growth ahead of it, regardless of what the Federal Reserve does with interest rates. If rates stay high, the consumer needs bargains. If rates get cut because of a recession, the consumer needs bargains even more. This heads I win, tails I win scenario is rare in the stock market and is a primary reason for today's bullish action. Comment below with the number of times you have visited an off-price retailer in the last month. Are you noticing more branded merchandise on the shelves? Let's talk about the competition because you cannot evaluate BURL in a vacuum. You have TJX companies, TJ Maxx/Marshalls, and Ross Stores. TJX is the gold standard, the reliable giant. Ross is the deep discount play. Burlington sits in a unique middle ground that they are currently optimizing. For years, the knock on Burlington was that their stores were too big, too messy, and less profitable per square foot than their peers. That is where the upside lies. The market loves a turnaround story. By shrinking their store prototype to a smaller, more efficient footprint, they are drastically reducing occupancy costs. If you look at the financial metrics available on SoFi active investing platforms or interactive brokers account reports, you will see that Burlington's sales per square foot have room to catch up to TJX. That catch-up trade is what investors are buying today. They are betting that O'Sullivan can close the margin gap. If Burlington can simply achieve the same operational efficiency as Ross, the stock is mathematically undervalued by 20 to 30% from current levels even after today's pop. We must also consider the role of the individual investor in this ecosystem. Platforms like Robinhood Stock Trading and SoFi Invest have democratized access to these types of insights, but they often encourage a focus on the most volatile assets. It is easy to get distracted by the daily noise of Robinhood cash management yields or the latest crypto spike. However, the most consistent wealth is often built in boring industries undergoing structural improvement. Burlington is not trying to invent a new technology. They are simply trying to be better at selling excess inventory than anyone else. This simplicity is an asset. While Apple stock has to constantly innovate to maintain its multiple, Burlington just has to open more stores and keep the supply chain tight. The execution risk is lower, yet the upside in a capital-constrained environment is substantial. Let's address the macro environment again. Inflation has cooled, but prices remain permanently higher. That $50 shirt from 2019 is now $75 at a department store. At Burlington, it might be $25. The gap between full price and off price has never been wider. This value spread is the moat. You might think that online investing trends favor e-commerce, but in the world of off-price, the treasure hunt experience cannot be replicated online. Amazon can't replicate the economics of selling a single unit of a random designer dress at a discount because the shipping economics don't work. You have to go to the store. This insulates Burlington from the Amazon effect that has destroyed so many other retailers. When you walk into a Burlington, you don't know what you will find, and that psychological trigger creates an urgency to buy that a static web page cannot match. Analyzing the institutional landscape, we see that ownership is heavy among the smart money. We're talking about massive inflows from pension funds and endowments that use Fidelity brokerage services to allocate capital for the next decade. These heavyweights are not day trading. When they enter a position, they build it over weeks or months. The price action today suggests they are stepping on the gas. They are looking at the 2,000 store target that management has outlined and doing the math. If Burlington can double its store count over the next decade while improving margins, the compounding effect on earnings per share will be massive. This is the classic rollout story,